Hello again. This is Grant Swartzwelder with Oilfield Strong. Welcome to another episode. I think this promises to be a fantastic one. I woke up this morning after Taylor Swift announced The Life of a Showgirl, and I said, how could this be any better? Well, it can be better because I have Rob Quigley here to present a fascinating topic. Rob is a managing director at VSO Petroleum Consultants. Most importantly, an Aggie engineer. There you go, a good whoop on that. Mm-hmm. He's head of their Dallas office, and VSO has a very interesting business model focused on buy side, the technical kind of advisory type work. So the topic today, coinciding with that, is eyes wide open. How do you buy assets in the oil and gas space? And so I think Rob is a perfect one for that topic. So welcome, Rob. Appreciate you coming. If you have a favorite Taylor Swift song, you're welcome to sing. I don't know if you've seen the most recent album. It's still coming out.
Just came out today.
It did. Well,
I didn't listen
midnight.
to it.
I assume you were on the in line at Target at midnight to get your copy. No.
Not quite.
No, well, I'll share with you the multiple copies that I got. I'm a little tired, but I'm going to overcome that. So, all right.
It's a big music weekend. You got Taylor Swift, and then the Red Clay Strays coming out too, another album. So,
and I don't even know what that is, so I'll trust that is something big. Okay, I just know, how can you compete with Taylor Swift? Anyway, let's compete with it by talking about A&D. Let's start off with just a big fat softball. Give me an idea about what the A&D market is looking like from your perspective, and we'll go from there.
Yeah, thanks, Grant. I appreciate being here. The A&D market is a little bit weird right now. You look at the metrics of what's transacting. There's not a ton of operated assets transacting. And by the way, where we live and play is really in kind of the A&D space, not the M&A space. So kind of the big public transactions, a lot of the times we're on the sidelines seeing the heart headlines or whatever, the energy news headlines. But where we typically play and are advising clients on are on kind of the middle, smaller market assets.
And define that for me, because everyone has different definitions of middle market. What rough size of transaction or size of company? How would you define that?
Yeah, I mean, we're really all over the board, but I would say good middle of the ground is, $50 to $200 million type transactions.
All right.
But we'll go a lot bigger than that and a lot smaller than that too. But it's not, the biggest thing is it's not kind of public names that are, trading with each other. So that's where we are. But that market there's been a lot of deals on the market, and kind of the sentiment from everyone is there's just very few closing. And so from a consulting side, we're super busy looking at everything, but a rate of close is not where people want it to be right now.
And I assume mainly price?
Yeah. I think it's mostly price differences. I think there's a little bit of a hangover of people still hoping that, debt is free, that prime rate is near zero, and it's not there anymore. Yeah. So
it changes economics.
When you're getting, bids for PDP, PV15 plus, that's a little bit hard to stomach when you're used to getting PV10, PV8 type bids. And so,
well, it seems like the winner of most of those auctions are maintaining the asset because you can cash flow it and get your money back in 3 years.
Well, that's the problem that people are looking at, is the offers they're getting is, if I keep my asset for 2 to 4 more years, I will have cash flowed what they offered me. And so that's the really difficult part that people are staring down, is that there wasn't a lot of inventory being paid for over the last couple of years. We're starting to see that come back a little bit. So for a while there after COVID, it was, PDP only, what people were offering. And we're starting to see some more value attributed to the upside. So from an operated perspective, there are a lot of assets on the market and very few trading hands. However, on the kind of non-op and minerals side, that's also extremely busy and actually transacting.
And do y'all focus on VSO do royalties non-op as well?
Yeah.
So any oil and gas asset
that's
y'all
right.
do.
Yeah.
So another interesting aspect of VSO that fits into this conversation is how y'all are more focused, or help me out, exclusively focused on buy side. Mm-hmm. What's the thought there of why focused on buy side versus any transaction, or buy side versus sell side?
Yeah, well, it's it's a little bit difficult to put on different hats. And when you put on a sell side hat, you're trying to paint the asset in its best light, plus sometimes.
You mean both sides don't go down the middle and do it fairly?
Well, it used to be that way. Back
It used to be a long time ago.
back in the 1900s.
There you go. That's when I first broke in.
Yeah, that's when I was born, luckily. But yeah, in the 1900s, my understanding, this is before I was in industry, but you would take, the same reserve report that you went and got a loan on, you would take that and hand it to a sell side advisory firm, and everyone would do their diligence on those reports. And then there was the advent of the, iBank technical team that helped put together, trying to paint the asset in its best light. And so, it's difficult for us to put on multiple hats. And so for better or worse, and frankly, why our clients like us is we call it like we see it, whether it's, good or bad or ugly, whether it's buy side or sell side, we're going to call it like we see it. And so from that perspective, most people who reach out to us are on the buy side because they want, you to call it like you see it, if that makes sense.
So what a great transition to talking about as you're looking at a transaction, a sell side person's perspective versus a buy side, and what, from a buy side standpoint, since that's your world, what do we need to worry about, or what do y'all worry about, from a reserve report to pricing to all the other technical type issues?
Yeah.
Give us some ideas on that.
Yeah. I mean, we're, typically when we're coming in to look at an asset, we're trying to look at what is the business case for this asset. And you said reserve report, and I would say, we do and can do and actively do sign and stamp reserve reports. But when you're doing kind of transaction analysis, it's a different lens in which you view what you're looking at.
How so?
Because you're with reserves, it's more of an accounting exercise. So it's very regulated from kind of PRMS, Petroleum Reserves Management System definitions of what reserves are, and it's more of accounting for what is PDP, what is definitionally a PUD versus a probable versus a possible location.
And on that, I would think PDP is a pretty standard definition for all sides.
That's true. Yeah.
So it's the PUD, the PDNP, but especially as you get into the P3s and out there, that it gets crazy.
Yeah, it's a little bit. Yeah, it's mostly focused on the upside is where it differs from a reserve report versus what you would do on a deal. And on deal work, you're less focused on definitionally what is proved, and more of what is most likely to happen. Like, how can I make money on this asset, and what is a reasonable underwriting case for the asset? So that's how I would differentiate between a reserve report versus doing kind of deal buy side technical underwriting. So with that, you're trying to dive in and basically, I mean, especially on the PDP, we're just trying to make sure everything matches to history, right? So we're going to put forecasts, go through and put our own forecasts on the PDP. And there's a lot that we can go into, but I just want to kind of give an overview first and then come back to it. You'll forecast the PDP and then go in and look at the commercial assumptions, right? And so what is the forecasted OPEX, differentials, all the commercial assumptions, CapEx that you're forecasting versus what has been done in the past. And so a lot of times what we're just trying to do is make sure all of the forecasted assumptions on the asset tick and tie to what has actually been done in the past. And there's a lot of, for lack of a better word, shenanigans that can go on trying to paint the asset in its best light through commercial assumption calculation. So trying to get like the base PDP set is kind of the first step. And then what's more abstract is what is the upside story here? And that totally can change based on what basin you're in, what asset type, so on and so forth. And so usually what we'll get is, the investment banker, whoever's selling the deal, will have put forth, a view of the upside. And so we're kind of brought in to help, wade through that and figure out, what is VSO's opinion of what's realistic, what's a business case, what's an underwriting business case.
Because wouldn't it be fair on the PDP, that's just a price sensitivity type issue. I say that, but then you talk shenanigans, and we can talk about op cost, water disposal, gas takeaway, all those type things. But as we're talking about just from a commercial and volume standpoint, the big sensitivity is the undeveloped, the probable, and how to value that.
You'd be surprised.
Really?
There's a lot of there can be a lot of movement on just forecasts alone, price change, like value changes.
And is that as far as just go back to my old engineering, just decline curve and what that looks like? Or are you talking like actual assumptions, or not assumptions, but the actual factors like op cost and some of those things?
Well, both, but let's start with decline curve analysis.
Okay.
Yeah. There can be a lot of there can be a wide array of differences. And what's interesting is we spend a lot of time teaching some clients. Like we get clients who are coming into oil and gas and who are, see the value opportunity in our industry and want to put money to work. But what they're sometimes blown away by is how wide the array of valuations can be coming in. Yep. Like how can you have an engineer, how can you put 3 engineers looking at the same asset and come up with, 30+%. I mean, that's an extreme example, 30%, but
maybe not.
How can you be 30% off from another engineer on an asset evaluation? How? And you can't. And a lot of it has to do with PDP forecasting, decline curve analysis, B factors.
And I guess that would make sense since, as you mentioned, so much of the value was just PDP, and I guess it's broadening out some, but a few years back, that was kind of it.
Yeah.
So it's
so it was a lot of arguing about B factors, right? So and it's really difficult to argue about B factors.
And what's a B factor?
It is the bendiness of a curve that you put on.
Is that an engineering phrase that I should know if I?
Yeah, all the engineers in the room are saying yes. B factors.
Okay, sorry guys,
it's the bendiness of the hockey stick. So if you have a B factor of 0, it's a straight line on a semi-log plot. And if it's a B factor of 1 or greater, it's very bendy. And what it's doing is basically saying, I think my rates are going to stay higher for longer in the tail of my forecast. And so one way that, sellers will try to paint the asset in the best light is put a higher B factor. And if you go from a B factor of, 0.8 to 1.2, it can really shift the value in kind of the tail. And so what our job is to come in and try to explain why we think the B factor is the way that it is. And it's really difficult to argue and convince an engineer one way or another. Like I'm pretty convinced that my B factor is right. Yeah. And other engineers are pretty convinced. And you can do some analysis to try to show that. But a lot of times we joke that it's like arguing about religion or politics. Like it's really hard to change someone's mind on B factor.
So you're kind of speaking the obvious that engineers are stubborn and like their own work, because I think that's an established precedent out there. So, but to determine that higher B factor, though, I would think would be driven by op cost, by water moving costs, which is all that, because if you lower that, then you should be able to extend out the economic life for a long time.
Sure. Yeah. Well, it's really driven by the reservoir mechanics is what it should be driven by. So if you lower your costs, yes, you can extend the life of an asset, but they're kind of two separate buckets. It's right. What will the reservoir deliver? What is the B factor is determined by the deliverability, the setup, the porosity, permeability of the reservoir. So that theoretically should be set by reservoir properties, and that's completely separate from how long I can operate an asset economically. So there's a bunch of ways you can get into the weeds on asset evaluations that make it, there's a lot of technicality to what we do. And there's a lot of art to it as well.
But most of these have offset operations, so there should be similar wells and similar production curves that I guess, but then you pick the one you like and they pick the one they like.
Well, that's And the range of the range of forecasts has really narrowed over time because you have actual offset analogs now in most basins. So it's pretty established there, but you can still, play with B factor by a couple of, going from like a 0.9 to a 1.0 is really hard to distinguish, and that can swing value a little bit. And so there's a lot of interpretation and uncertainty there still. Yeah.
So I now have a new terminology, B factors, but let's go back to my other favorite one you've thrown out is shenanigans. And let's talk about what a buyer should look at or look warily on, op cost, other things like that could obviously affect value.
Yeah, so you got to get your forecasts right. You have to get your reserves, your decline curve projections right. And then the next step is the commercial assumptions. And so what a lot of times we'll see, and it really varies from deal to deal, how the bankers decide to put the valuation together. But what we're always doing is looking at the historical financials. So just over time, what has the OpEx been, over time, over the trailing 12-month period, and what are they projecting? And sometimes it ties out. Like if it was, $5 million a month to operate this asset, sometimes you'll show, $5 million month one of the forecast, and that's a good tie. But a lot of times there will be some optimism baked into commercial assumptions. So maybe they'll, instead of that $5 million a month to operate, it's $4 million or something like that. And they'll put together a story about why, it's optimized. Maybe workovers, all the workovers that we had to do over the past year are non-recurring and they're not going to happen anymore. So you can play with the numbers and try to convince yourself that it's going to get better. And so what we're often tasked with doing is just making sure that let's at least establish a base case. You might be able to optimize an asset going forward. And you can bake that into the bid you put in on the asset. But first we have to get, as is, unaltered, what are the commercial assumptions going to be? And so there's a lot of ways that you can manipulate the data to look more optimistic. Like another one is fixed versus variable costs. We'll always look at what portion of the operating costs don't go away over time and what portion decline with production decline. So if you have saltwater disposal cost, there's a dollar per barrel cost there, that as the amount of water you produce reduces, that your saltwater disposal costs should go down, directly correlated with the amount of water.
Or the flip side is the well depletes, a lot of times the water volumes go up.
That's right. Yeah.
So it can work either way.
That's right.
But
yeah.
yes,
but
I got you.
And then there's fixed costs. Like you always have to have a pumper come out and look at the well. And so like that pumper is always going to have to come out there, and there's some overhead associated with that. So there's some portion of the cost that should decline over time and some portion that, should stay flat over time. And you can play with those numbers a lot. If you dump a lot of your costs on variable costs, that extends the life of your asset and ups the value. So we're doing a lot of checking there. So these are the nuances of how you can manipulate things to put the asset in its best light. Yeah.
A couple other topics associated with that I'd love for you to discuss. Out in West Texas, especially, they talk about gas takeaway, limits to pipeline. You have to shut things in. You have to flare gas because the pipeline or the compression isn't there. How do you figure those things out? Because that could have a huge effect. New Mexico, if you can't have gas takeaway, they'll shut the whole well in.
Right.
The reserves are there, but the cash flow sure isn't. So how do you figure that out?
Yeah, we used to have to, we would have a swath of an asset where they were flaring 100% of the gas. And so that we would just have to make sure that those gas streams were not shown as receiving revenue, because sometimes you can play with, well, in spite of that we're flaring right now, we're going to stop flaring.
As soon as you buy it, you'll be able to sell 100%.
That's right. And all of a sudden I'll get, $2 an M for every.
Funny how that happens at transaction date.
Yeah. But, operators have gotten better about reducing their flaring, all that stuff. So, and sellers have realized it's become less common to try to bake in that optimism. And so usually what we're seeing now is they're pretty realistic about what percentage of the asset is flaring versus going to sales. And we can usually project it along those lines.
And kind of same but different. Again, out in West Texas, I was talking to some folks where their price at the terminal is a negative number. And then you have transportation, so it's actually a liability. So you want to flare,
Yeah.
but if you can't flare and you're getting a negative number, what do you do with that?
Yeah, gas becomes a cost.
Yeah, huge liability.
Yeah,
it seems like
it's no longer a revenue stream. And yeah, we've seen Waha blow out for an extended period of time. And right now it's kind of in that you might be making a few cents one month and, losing money the next month. So It's a real problem. I mean, luckily it's vastly an oily basin. So already, 90+% of your revenue was going to be from liquids anyways. But yeah, I mean, gas can be a real cost.
And another byproduct is water. And you mentioned saltwater disposal, but that seems like it could be a huge issue, fixed variable like you talked about, but just even the kind of the liability associated with it and how do you transport it, pipeline versus trucking. Can you find a disposal well? Thoughts?
Yeah. There are always unique setups on how they're handling water, and it is usually a topic. They'll spend a slide or two in the management presentation on, we've got everything covered on water. And yeah, sometimes they're trucking it, sometimes they're tied into a disposal system. So, again, part of the diligence effort is making sure you understand what they're doing, that they have capacity, and that they're modeling it correctly. Because yeah, if you're going to truck it, it's a lot more expensive than you're tied into a gathering system. And I mean, luckily there's a lot of, there's a lot of companies making a lot of money gathering water out there.
Clearly.
So we're actually involved in a lot of those kind of processes as well, of helping those water gathering, the midstreamers, the water gatherers out there. They're all wheeling and dealing and transacting, and so we're kind of get to see some of those processes as well. But yeah, there's ongoing need for water disposal as water oil ratios will come up over time in the Permian.
Another topic: inactive wells that potentially need to be plugged.
Yeah.
In the old days, when I was an engineer, you would just push that off to 20, 30 years from now, so that the value, if there was any cost to it, it was so far out there that the discounted value of it was negligible.
Yeah.
Well, that's starting to change, or is it? How do you look at that?
It is mostly changing, but it still varies from deal to deal. I mean, for a while there, we would just see P&A ignored altogether.
Yeah.
You would just get a report with no plugging costs in it. And we would have to go back and say, oh, we got to put this in. And then all of a sudden it could be a material change to value. A lot of the times what we'll do is, if there's a big bank of wells that need to be plugged, is we'll do kind of a 10% per year kind of model, where we're saying, hey, you take this asset down and you're going to commit to, some plugging program, so that, you're plugging 10% of all the, bank of plugging liability wells. But yeah, we're seeing some reports where you are shoving, all the P&A out, 30 years down the road, where on a discounted basis it's negligible. And so that's just something that we bring to, clients' attention. If it's a high well count asset, I mean, I think everyone's kind of woken up to that narrative now, and that's something that you really stares you in the face, and most sophisticated buyers are thinking about that now when they're taking down an asset.
Yeah. Kind of a subset of that, though, also is if you have inactive wells, the reason you keep them inactive or don't plug them is because, by God, I'm going to go to a upper zone, or I'm going to re-enter and do something. Well, if they've been inactive too long, as we know, the cement, the casing gets contaminated and rots out, for lack of a better word, with the water that's been in there and all. So that wellbore might not be usable. How do you figure that out as a buyer?
Yeah, that's a good question. That's frankly not something we typically focus on.
No, well, and it's hard because it's downhole, and but it exists. It's like, at what point does it become where you have to plug it, and you can't use that as part of a discount on your PUD or probable?
Yeah, I mean, most of the stuff we're looking at everyone's focused on the horizontal wells, and you might have this swath of historical vertical wells that are swept off to the side and not really talked about. And yeah, that's a good point. From an environmental liability perspective, people should look at that, but that's kind of outside of what we typically look at. And I hope they're engaging folks to help them look at it.
Yeah, no, fair. So earlier you talked about how the value increases or the big swings are in the probable, possible, potential drilling. Let's talk a little more in detail on that, talking about from, they're talking horseshoe and U-curve and all this type of drilling, additional refracs, all those type of completion and drilling potential that exist. I assume you're seeing more of that out there as the technology seems to expand. What are you seeing? How do you evaluate that?
Yeah, there's people are getting creative with their assets as they run out of kind of the obvious inventory to drill. The question is what's left for them to do and what's left for them to put in a sales report when they're trying to sell the asset. So it requires some creativity, and people are getting creative. I mean, it kind of varies by basin. We were involved in a lot of Eagle Ford processes over the past, call it year or 18 months, something like that.
It's been a lot of consolidation down there.
Yeah. And the hot topic down there was refracs and infills or redevelopment. So, and really the refracs were kind of the new hot topic that, operators were starting to show that there was enough data to show that they were actually working in the kind of if you were deep enough with enough pressure, they're working. We could go off on a refrac debate because the question is, where does it work? And it most certainly doesn't work everywhere and not with every well.
Well, I assume the data on that is it's working, but for how long? Because I assume most of that's only a last year or two.
No,
has it been a while?
There's been enough that I'm being convinced that there
is true value. It's couldn't just fall off the cliff shortly after.
Yeah. And so every people saw that kind of narrative come through, and there was a lot of assets that tested the market because here's the next, here's a new trend that's real. And so can I put that story on my asset and bring it to sale? And a lot of times, we would advise clients to put value on those refracs. But the real question is being selective on which candidates, which wells are actually candidates for refrac. So I would say in general, the sellers are oftentimes over optimistic on the number of...
Meaning every single well they have is a candidate.
Right.
Okay.
Yeah. We just drilled a well and it's already a refrac candidate. That's obviously they didn't do that and not the case. But so yeah, we saw that trend and that's a real trend in the Eagle Ford. And the other trend in the Eagle Ford is redevelopment opportunities. And so they're going into sections that were drilled in 2012 to 2014, 15 with smaller fracs that are being done today. So they didn't frac that section with big boy fracs like we are now. And so operators are going in, like especially in like the core of Karnes Trough, and redeveloping a full section. So there'll be, 8 wells drilled across a mile wide DSU, and they're coming back in and, picking lanes in between the pre-existing wells and drilling new wells and fracking them and bringing them online and making good rates. And so that is an additional narrative that people are putting on assets to create value in the Eagle Ford. So there's the refrac and the redevelopment theme in the Eagle Ford.
Right.
That same theme is happening in the Bakken, in the Williston Basin. So there is also that same, those two basins have the most refracs and redevelopment candidates going. And so that's kind of a late, in the last couple of years, trend in both of those basins, where folks have picked up on that story. They're either actively doing it themselves, refracs and redevelopments, or they have an offset operator that are doing them and say, hey, we have analogous data now that we can throw this in our asset sale report. And so that comes to folks like us, and we have to wade through the details of how real that is or not. So,
and would a refrac, would that be a PUD or is that a probable? And I know y'all don't do reserve report. I'm just kind of wondering where that would be, because obviously, depending on where it is, you'd have a certain discounting factor on that.
Yeah.
So how much should you get paid for refrac potential? I guess is a better way to ask.
Yeah, that's a good question. We haven't had a reserve report where we've had to make a call, but I think you could probably convince yourself that they're PUDs.
PUDs,
Yeah.
because it's existing production, you're just adding to it, and so the discount factor would be a lot less than obviously in a probable possible.
Yeah.
Sorry, the mind wandered.
Yeah,
on that
no, it's all good.
The last big topic I want to talk about is, and again, I know you're on the buy side, but setting up a data room, and either from your perspective, from a buy side, what you like to see, or from a sell side, what should they think about so that either their credibility or the value can be improved. Got some thoughts on that as to what, I assume kind of what price deck they're using to what type of information they're providing, how it's set up. Any thoughts on that?
Yeah, I think the biggest, there's some obvious things on just basic data that you want provided, and you want your PDP forecast to be realistic. You want to at least show that the financials tick and tie with the historicals. So on the producing side, there's some basic things that we're always looking for, and I always appreciate when banks make an attempt at making all those things tie, because I think you're the spread of bids that you get. This is my opinion, but if you put a more realistic answer out there, then you might get a more serious bid from more folks, kind of a thing. And I think the days are gone where you're getting kind of an unsophisticated buyer taking your report.
But isn't that kind of what the seller is looking? They're looking for that one that's willing to overpay.
Yeah, and that's why you do it.
Yeah.
And I would probably do that too, because, the chance of that happening, then that makes everything look good. But the other side of it is that you also can create unrealistic expectations from your client that you're trying
and probably
to sell.
Financing challenges and closing challenges.
Right. Yeah. You're painting the asset in a light that could not be realistic. And so then that could lead towards deals not closing. If you're saying you can get, 2x, what you think it's worth, I would want to get 2x what I think my asset is worth as well. So that's why you paint that upside story. I think, and so the biggest kind of artful thing that I would like to see, like realistic upside analysis, is a strong justification for, why they put those upside sticks out there. So we've seen some reports recently, particularly in the Permian Basin, where because of the stacked pay in the basin, you can really stick up, quote unquote, a lot of benches that, like I just looked at an asset that had one first bone spring test in the area, and the seller booked 150 locations across an asset based on that one test, and so that is stuff that we don't like to see, but we're also, it's kind of weird because we're used to seeing it and just kind of writing it off. But that's kind of the weird thing about especially the Permian, because of all the stacked benches, is that they do want to show off all the oil in place, and that first bone interval that I mentioned could be there, right? But it probably doesn't work till $80 or $90 oil or something like that. And so what's the option value of this upside bench? Ultimately, most folks that we work for are just you're not gonna put in a serious bid with that upside bench. And so I think what I like to see is just good justification for kind of your primary benches, what you can put out there, all of the upside benches that you like to show, but what is the good kind of type curve, offset analog, geological, show me the mapping of why this thing works, the good backup that on why the type curve is, why the rate of return is what it is. And banks have actually been doing a really good job of that, frankly, most of the time.
You talk about upside benches, and for most part, that the production is there on a lot of them. Some maybe not, but how do you deal with the question of, do you wait and just go up hole, which is maybe more of a vertical thought process, that I'm used to, and so therefore that production is pushed out several years versus drilling a new well. And I guess in West Texas, it's all about drilling a well because you're doing a horizontal.
Yeah. Yeah, and that's kind of the theme in the Permian Basin is all this stacked pay. How do you exploit it? And there's a time factor. There's a parent-child factor that you have to deal with there. So the parent-child terminology is
it's been talked about because it affects the parent is affected by the child.
That's
and
right.
The frac and all.
Yeah, and so you could show in the Midland Basin, you could drill up your Wolfcamp A bench across your asset, across a DSU, and theoretically there's a Wolfcamp B bench below it. But what industry has come to learn is that there are significant depletion effects, not just horizontally. The industry took a little while to understand, same bench depletion and parent-child relationship effects and spacing effects. And the industry is learning now there's also a vertical component which affects, your future inventory. So you might, if I pulled up a map of Wolfcamp Bs across someone's asset, they could say, well, look at this. Look at all these DSUs that don't have Wolfcamp Bs drilled in them yet. I should be able to drill there. And so, sometimes you can, but a lot of time if there's an A bench already drilled and you're trying to come in and drill the B, those B wells will feel the effect of those A wells. And so that doesn't necessarily condemn that acreage necessarily. Sometimes it does though. Like if there's enough depletion effects,
but how do you know?
Yeah, well then you got to go in there and do the work. And that's kind of the nuances of how you're trying to tell the story of an asset, particularly with stacked pay, is we really want to see kind of that depletion, that vertical depletion story told. And I think, and it's still a relatively new problem that operators and industry is dealing with. I mean, it's not new, but people are waking up to that fact that depletion is happening. And so can banks come up the learning curve of, okay, yeah, I can put out a curve for the Wolfcamp B that's underneath a pre-existing Wolfcamp A, but I have to account for the depletion that happens there. So we're used to accounting that in our workflows, and we hope to see that in the sell side work. But what that requires is it's a more nuanced analysis. You can't just build a type curve and carpet bomb the whole asset with the same Wolfcamp B type curve everywhere. Sometimes it's on a section by section basis, or it's like, okay, if I look at a gun barrel diagram, which is the face on view of where all my sticks are landed and what bench, I need to account for all of the orientation of all the other wells that have already been drilled to give a realistic type curve for those remaining wells. So it just gets a lot more challenging and nuanced, and it's not unknowable. You just have to account for it properly to not get surprised. And so all that just takes nuance and time and understanding from folks.
And maybe an argument for why they should contact VSO Petroleum Consultants to help. I know you weren't making that as a pitch, but it seems like a logical transition there. Rob Quigley, I really appreciate you being here. Fantastic. I knew it would be, and you hit it out of the park. So if you like what you've heard on Oilfield Strong today, please think about following us or forwarding this to other people. I think we're growing. Hopefully this is a good example of the type of material and educational items and process that we provide. So hopefully you'll join us for our follow-ons. We are going to leave shortly and try to compare The Life of a Showgirl to Dead Poets Society and see what is a better. As you can tell, I'm trying to become the energy podcast for all Swifties, which I don't know if that's a huge market, but we're going to give it a try. Thank you very much.